Hello, everyone. Happy Friday. Last homework assignment of the semester. I expect your best efforts, most participation, most nodding and agreement, okay, or disagreement if I say something wrong, which I might, Brett has got it down. He's going to kind of like move his head in just various directions. Yeah. 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 So just a reminder, Monday we have our exam review. That will include reviewing the study guide and talking about the questions on the practice exam. And then Wednesday we have our exam. And so yeah, two more exciting days of work, and then we got presentations the final week of class. With that, let's go ahead and start working through some of the stuff. I really like chapter 16 in this textbook. I really don't like chapters 14 and 15. I think that the way they test it is inconsistent. There's some information that we're going to go through that I'm going to say it's not necessarily indicative of what you should expect on the exam. And I'm going to close the door because too much laughing. The auditing class, there's no laughter allowed. What did I just say? Yeah, that's right. That's right. All right. Obviously, ridiculous. But anyway, so with that, let's go ahead and get to the multiple choice questions, and let's get through the rest of the assignment. 1413. Which of the following internal controls is most likely to justify a reduction of control risk concerning plant and equipment acquisitions? Now, I don't like the way the question is worded because it implies that everything that's listed below is an internal control. It says which of the following internal controls. It would say which of the following. If it said which of the following is an internal control, that would be more appropriate because some of the things that are listed below are not internal controls. At least I don't believe that they would be an effective control. So let's go ahead and go through each of these and see what we identify. So justifying, so we first of all need to identify control and something that's used to justify a reduction of control risk concerning plant and equipment applications or acquisitions. Man, I'm really struggling today. Sorry, I'm in the process of getting my computer replaced, and so I have not had time to prepare or to really get my mindset on this class. So you have to forgive me, okay? And yeah, I will do better moving forward from this point. And Hudson, I'm sorry I chastised you. Okay. Okay, good. All right. What do you guys think? Periodic physical inspection and reconciliation of plant and equipment to the detailed accounting records by the internal audit staff. What do you guys think? Does that sound like a good control? Yeah, it sounds like it's probably our answer, but let's go through the rest. Comparison of current year plant and equipment account balances with prior year actual balances. So what do we know about controls? Controls generally focus on transactions and events. Does this sound like something that's focusing on transactions and events? No, this sounds really like an analytical procedure, to be honest. Review of pre-numbered orders to detect unrecorded trade-ins. That sounds like an audit procedure to me. That's something I would do as a test of controls, but not a control itself. An approval of periodic depreciation entries by supervisor independent of the accounting department. Okay. So are we going to be concerned about depreciation if our control risk is related to plant and equipment acquisitions? No. This might be an effective control, but not in the area that we're specifically identifying. Because remember, it specifies plant and equipment acquisition, so we wouldn't care about depreciation entries. That's not something we'd look at. So A is really the only answer that makes sense in this context. All right. This next question is a little bit better. I do like this question. You have to think about this one. Property acquisitions that are misclassified as maintenance expense would most likely be detected by an internal control system that provides for what? So before we answer this question, what happens if we have a property acquisition that's classified as a maintenance expense? What is misstated? Well, there's going to be two accounts that are going to be misstated. There's going to be the maintenance expense account itself, because it would be overstated because it's going to be misclassified as a property account, or sorry, misclassified as a maintenance expense. What would be understated? The assets, the property, plant, and equipment, because we would classify those, we would capitalize those costs as cost of the asset instead of maintenance expense. So two items that are being misstated. So anything that can actually identify or detect those misstatements is what we're looking for here. So again, go through the answers. Investigation of variances within a formal budgeting system. What do you guys think? That seems like so commonplace. What do you guys think of that actually to identify this issue? Yeah, that's the entire purpose of variance analysis, to identify differences in expectation with respect to expenses. And so if we're saying that maintenance expense would be understated, we would look at our budget and say, we expected maintenance expense to be higher. Why isn't it? And so this would be something that would identify it. So this is our answer, but let's go through the rest. Review and approval of the monthly depreciation entry by the plant supervisor. Okay, this doesn't have anything to do with the depreciation, so no. Segregation of duties of employees in the accounts payable department. Segregation of duties, I like that as an answer in general, but that's not really appropriate for this particular question, okay? And then examination of the internal auditor of vendor invoices a canceled check for property acquisitions. So this would actually identify if property acquisition took place, but that's not what we're talking about here. We're talking about misclassification of the transaction itself. So not the exact transaction took place, but whether or not it was properly classified is what we're concerned about. So A is our answer. It's really intuitive that is. It was the one that makes sense. Yes.
What if you're just appreciation if you have those capitalized assets?
Yeah, I think that there's an argument for that. I think that would be less a second order effect, though. So I think that you could identify that as a potential reason if you say that the depreciation is less than you would expect it to be, but it doesn't necessarily specify that we're trying to identify. Are the depreciation different from our monthly expectation, but it's actually specifying reviewing the entry to see if it's correct or not, the accuracy. So that's kind of how I would read into that. That being said, if you did have like a formal budgeting system where you're analyzing depreciation expenses and the difference was extreme, you'd say, why is this not as high? And the answer might be it's because property, plant, and equipment is misstated. So there is an argument for B for sure. I think A is a little bit stronger argument though. 1422. Which of the following combinations of procedures would an auditor be most likely to perform to obtain asset evidence about fixed asset additions? Okay, so we're trying to obtain evidence about fixed asset additions. So items that were added. Remember, when we talk about testing fixed assets, when we talk about property, plant, equipment, we're just looking at changes in items most of the time, because that's what the whole purpose of the roll forward was, is to look at what we know what the beginning balance is because we audited it in previous periods. We're trying to prove the ending balance. So let's just test everything that occurred in between. Now, if we're talking about additions of fixed assets, what is our most likely assertion concern? What assertion are we most likely concerned about with respect to additions in fixed assets? Probably existence occurrence, yeah, making sure that those actually took place. So keeping that in mind, assuming that we're probably concerned about existence occurrence, what would be a good one? So inspecting documents and physically examining assets. Would that be a good test of existence occurrence? Yeah. By the way, I didn't intentionally actually pick the 3 questions that were all with letter A as being the correct answer. It was just kind of happenstance. But yeah, A is a really good one. The rest of these, I think that they're fine tests, but they're not necessarily tests of what we're trying to identify with respect to fixed asset additions. So A is our answer. Moving on to chapter 15, 1512. An auditor's primary purpose in examining a letter received from the bank shortly after the balance sheet date that renews and extends an entity's note payable is most likely to obtain evidence concerning management's assertions about what? So what is the concern? What is this dealing with? We had a note payable, and what happens to notes payable that eventually happens? They become due, all right? So a long-term note eventually becomes due, it becomes a current liability. This is saying we've requested from the bank, our client is requesting from the bank that we want to extend this note payable for some determinate length of time, meaning that it's going to continue being a long-term liability. So it's not going to be a current liability, but it's going to be a long-term liability, which is an issue of what type of concern. What assertion will we say most closely represents that? Probably classification would probably be a big one. We could also say that to some degree, that's also going to be cutoff recognition at a certain point in time. So the answer is B, although I don't like the way that they word this. Presentation cutoff and disclosure dash classification, okay? Again, this was some editor at the book who was writing this question and say, I'm just going to throw words up and they say they look good, okay? So classification would be the one that I'd be most concerned about is classification, and then cutoff to a lesser degree. Presentation, you can make an argument for, because if you've got an outstanding liability of this nature, you'd want to disclose that in the financial statements. But I think that's a subsidiary concern. And the simple truth is none of the other items actually make sense in this context. Classification is really the only one that matches. All right. 1519. An auditor compares the current year revenues and expenses with those of the prior year and investigates all changes exceeding 5%. By performing this procedure, the auditor would be most likely to learn that what? This is an interesting question. This is a really interesting question, and it requires you to think a little bit about what the nature of the transaction is. Okay. So remember, we are in accrual-based accounting. As much as I might hate it, as much as I might say accrual-based accounting is ridiculous, okay? That is what you all learned back in 220, and that's what you've been using moving forward, okay? That's what you've been like Dr. Eisen and Dr. Shoney have all taught you is accrual-based accounting. And what is the nature of accrual-based accounting? that our revenue recognition and expense recognition is separate from when the cash receipts necessarily take place. So we can recognize that revenues in advance of cash receipts. We can recognize expenses in advance of cash disbursements. There's a timing difference there. So if that's the case, would fourth quarter payroll taxes in the current year that were not paid, would that affect revenues and expense recognition from previous periods? So in the previous period, they recognized the fourth quarter payroll tax, but in the current period, or guess they paid the fourth quarter payroll tax already, but in the current period they had not paid it already. Would that affect recognition of expenses? Think carefully. It would not, okay? Because we're not talking about the recognition of the expense, we're talking about the payment of the expense, okay? So the recognition of the expense takes place first. You've got a payable and you've got a debit to an expense. So that expense recognition has already taken place. So that wouldn't actually affect the expense balance. It would affect the payable balance, okay? And so if they were not paid yet, again, that's the separation. That's the accrual we're talking about, which is the tricky one here, because you look at A and you think, oh, obviously that's going to affect expense recognition. The expense has already been recognized. We're talking about the payment has not been recognized. The entity changes capitalization policy for small tools in the current year. We just talked about this, okay? Capitalization. What does capitalization means? It means that certain expenses are going to be incurred or be accrued as a cost of the asset. Other expenses are going to be recognized immediately when incurred, okay? If they change their capitalization policy saying, okay, we're going to capitalize fewer of these costs as cost of the asset, is that going to affect expense recognition? It absolutely will. It absolutely will. So B is our answer in that situation, is they change that. That would be the scenario that if we looked and saw a change in expenses, but we want an explanation, we'd find out, oh, they changed their capitalization process. So that means that the expense amounts are going to be different. So that'd be an identification. All right. That was kind of those are kind of rough questions. Those are kind of rough questions. Let's move on to chapter 16. Get out of my way. Get out of my way. Somebody watching this video is going to, what the hell is he doing with the mouse? Okay. I'm trying to get this window out of the way. And you notice it won't go away. I'm just gonna back up there. See, there we go. Now it's agreeing with me. Okay. Yeah. All right. So real quick, we've got a bank transfer schedule here, and it says date dispersed per and date deposited by. Now, these are really confusing the way the terminology works, but let's just go ahead and clarify this. Traditionally speaking, when we have disbursement from the bank, particularly if we're talking about a written disbursement, what do we usually call those? A written disbursement from a bank? Probably don't write many of those, but I wrote one actually yesterday when I was over at the at City Hall yesterday. I wrote one. A check. Yes, this is a check. Okay. And then date deposited per, if we have put money into a bank, that's called a deposit. All right. So let's keep those in mind moving forward. So that's what the tick mark most likely indicates that the amount was traced to. So we're trying to, and by the way, don't use the word trace as what it's intended auditing. This actually happens a lot in this chapter. They use the word trace and they don't mean tracing. Okay. They're just saying tracing as a word. It's like, yeah, tracing, like you are drawing a line. You're drawing a line between one point and another. That's what tracing means. Stop it. You're making me dumber. All right. So yeah, that's not what we're talking about. We're talking about tracing. Okay. Tick mark that's a diamond most likely indicates that this amount was agreed to. We'll say for that. Well, what is it that we're trying to determine from disbursements? What we're trying to make agreements to? We're trying to see what checks were written and what checks are still outstanding. Okay, what checks have not cleared. So if we got these items here that just cleared, saying this is going to be the outstanding checklist of the applicable bank reconciliation, because that's what a disbursement is a check. That's how we identify it. And the tick mark of this triangle is most likely the amount was agreed to. And what do we say those are? Those are deposits in transit of the applicable bank reconciliation. So items that we actually have in transit, we actually look at what is the type of transaction we're looking at. This is your checks, these are deposits, and then we're going to agree that information. Not trace, but agree. 1615. The primary evidence regarding the year-end bank balances is documented in what? All right, so let's just go ahead and go through this. All right, go through the process. We have 3 documents that we need to note, we need to have in order to test the bank reconciliation. The first one should be obvious. If we as the auditor are testing the bank reconciliation, the very first document we need is the bank reconciliation. That's right. We went over it 2 days ago. Yeah, we need the bank reconciliation, all right? So remember, bank reconciliation, we're trying to prove the book balance. The bank reconciliation is trying to determine what is the difference between the book balance and the bank balance, and what are all the adjusting items that are in there. So we need to actually be able to test or to determine what is the bank balance and what are those adjusting items. Okay. So that is our goal here. Now, this question is saying the primary evidence regarding that bank balance, that top of the line item that we're going to use before we start making the adjustments, where do we get that information from? What was that document called? It was our second document. So the bank is a third party. A third party request is, everybody's really shy today. Everybody's going to think, say, if you start laughing, I'm going to chew you out. I'm really sorry. It was a joke. It was meant as a joke, guys. Okay. Don't be afraid. Okay. Don't be afraid. You know what this is called. Confirmation, standard bank confirmation. That was our second document. Okay. We get our evidence to the second document, standard bank confirmation. Now, just as a review of this process, just to make sure we have the holistic process, because this is really important. Excuse me. We have the third document is basically going to tell us the evidence that we're going to have with respect to whatever it is that that's not cleared yet. Okay, whether that be checks, whether it be deposits in transit, all those items that have not cleared yet. Eventually, they will clear. So we're going to look at some point in the future. All right. What is that future-looking document? That document that we're going to get 7 to 10 days in the future. Cut off bank statement. Good. Right. Okay. So those are going to be all those items. Now, just as a reminder, you do need to know those 3 items and what their roles are. Okay. If we suspect fraud, there are 3 other documents that we might collect as part of this process. So remember, we said extended bank reconciliation procedures, which you guys actually had a look at for your testing of cash for your earthware clothiers assignment, proof of cash, and test for kiting. That's basically all you need to know. You need to know the three names of those documents as well. Those are only if fraud is suspected that we would actually use those. So going back to our information here, we said the primary evidence regarding year-end bank balances is documented in the standard bank confirmation and accompanying reconciliation. Okay. So moving on, question number 19. Auditor testing long-term investments ordinarily use substantive analytical procedures to ascertain the reasonableness of the what. Now, this is an interesting question. Okay, this is an interesting question because you hear long-term investments and say, well, Dr. Barnes said that the primary assertion is going to be existence. And I'm going to say, well, yeah, that probably is the primary assertion. But will we use substantive analytical procedures to test existence? No, we would not. Okay, no, we would not. If you remember back in chapter 5, I said there are only 2 assertions that substantive analytical procedures can test. Does anybody remember what they are? One of them is going to be like 90% of the time that we're going to be talking about. VAA is 90% of the time. What's the other one that's only used like 10% of the time? Completeness. Okay, so it's going to be VAA or completeness, which interestingly, both of those are listed here. So we can ignore A and C. Now, let's think about what this is going on here. So valuation allocation accuracy is one of our defaults. We say if it's going to be an analytical procedure, it's going to be that one. So is that what's the case here? It says valuation of marketable equitable securities. Do we as the client or our client, does our client care what the market value of securities is? No, they're not concerned about the market value. That's an external trading. So valuation is not relevant. This type of valuation. Not saying valuation is not relevant, but this type of valuation is not something we test using an analytical procedure. Would they be concerned about the completeness of recorded investment income? Yes, and that sounds like something we develop an analytical procedure to perform. So yes, okay. So that's our answer. That's our answer is the completeness of recorded investment income. All right. So 1620. Or to establish the existence and rights of a long-term investment, so we can just basically say existence because those are kind of the same thing in this context. Long-term investment is common stock in a publicly traded company. An auditor would ordinarily perform a security count. So remember, we talked about this. This is a physical inspection, or looking at the securities themselves if the client has possession of them. But does the client always have possession of the securities that they own? No, there may be a third party that has possession of those. So we want to actually make an inquiry of the third party or a request from the third party, which means that we're going to be issuing a confirmation, confirms the shares that are held by an independent custodian. Okay. Those are the only 2 processes that we can actually use to test investment or existence. By the way, you will notice existence and rights are often listed there. You will see that in the book if you've done some studying here. For context of investments, when we talk about existence and rights and obligations, they're effectively the same assertion because if they exist, we have the right to them. Okay, because most of them are going to be who owns those items. That's going to basically be the same concept. That's only true for investments. It's not true for other concepts, but it is true here. All right, moving back to chapter 14. Let's go look at a problem, shall we? So I'm not a real big fan of this question, but it was the best question I found out of all of these that tested the concepts I wanted to note. So what we're just going to do is we're going to note there's audit procedures listed here, okay? And then we're going to look at the different specific assertions that are used to actually test, or that are going, the audit procedures can use to test. So we're talking about property, plant, and equipment. We want to verify the following assertions. To verify the entity has legal right to the property and equipment during the year, and that's going to be rights and obligations, okay? Want to verify the recorded property and equipment represents assets that actually exist at the balance sheet date, which is going to be existence occurrence. And then we're going to, sorry, I'm getting off track here. Verify the net property and equipment are properly valued at the balance sheet date, which is VAA. Okay. So let's just go ahead and think about these just logically. Before we look at the answers, so look at the list of answers. Let's think about how we would test these, just even if we don't know what the procedures are. Let's just think about what it is that we would do, intuitively speaking. So the entity has legal right to property equipment during the year. What is it? Does anybody have a car? Anybody own a car? What actually is it that shows you that you have legal rights to that car? Your title. Okay, so we want to look at something like the title. Okay, so if that's the case, we're going to be looking for items that actually show documentation for ownership. So if I examine the deeds and the title insurance certificates, is that going to be sufficient in that regard? Yes. So we have the right to actually represent that as an asset for ownership. So that was a little bit more challenging. This one should be an easy one, though, okay? Verify that property equipment represent assets that actually exist at the balance sheet date, so existence. What is the number one way for us to test property, plant, and equipment for the existence assertion? What is the easiest way for us to do that? Inspection of tangible assets. Look at that. Look at those assets. Go and we'll see those. So physically examine all major property and equipment additions. So number 7. All right. Then finally, so review the net property and equipment are properly valued at the balance sheet date. All right. So what is it that we're concerned about with respect to property equipment with valuations? Because remember, all these items are recorded at cost. Okay. So the only one thing that's going to change, that historical cost for the property, plant, equipment is not going to change. What is it that when we talk about the net book value of a property, plant, equipment, what is the value net of? So you remember, you look at a book, you see the assets, and you have something listed below there. It's called a contra asset. What is that called? Accumulated depreciation. Okay. So if we want to know proper valuation, we want to make sure the depreciation calculations are correct. Okay. So if that's the case, we're going to review the provision depreciation expense and determine the depreciable lives and methods used in the current year are consistent with those used in the prior year. That's going to be our VAA test. All right. So even though a lot of these were really, really gobbledygook and nonsense, I don't really like the other audit procedures they listed. The ones that were correct answers were fairly intuitive, consistent with what our expectations already are. All right. 1522. All right. So Brandt Group reported the total interest expense of $2,000, and then we've got the monthly balance of their long-term debt. Interest paid on the monthly average daily balances during the month. The annual interest rate of the debt is 6%. Based on the data provided with auditing the Brandt Group, would you consider the reported interest expense fairly stated? Why or why not? Okay. So what do we need to do to answer this question? Sure sounds like we need to develop an expectation for interest expense. Okay. That's an analytical procedure. Have we done this before? Yes. This is just a reinforcement of something we've already done. So let's go ahead and pull out the calculator. Whether you want to pull out the physical calculator, I'm just going to put the calculator up right here. Okay. So remember when we did this last time, we said, what was the average monthly balance over the period of time? Because we have 12 months and it shows the balance at the end of the period. So if I add all those together and divide by 12, would that give me an average balance? Yes. So I've already done that, by the way, many, many times, by the way. All right. So 76,250 is the average monthly balance. Now, if this is my average monthly balance, and I know that my interest expense is going to be 6%, would it make sense to say that I should expect that 6% times this amount should be what what the client's interest expense should be? So let's go ahead and multiply this times 0.06. 4575. That's our interest expense that we would expect as auditors based on these criteria. Okay. And this is a reasonable assumption because you look at the balances These all average out to that amount of like 75,000, 76,250. And 6% what we would expect to be accrue every single period. So 4575, is that close enough to 2,000? Answer is no, but how do we know? What do we have to do to make that determination? What did we call that back when we did the analytical procedure? We had to calculate the tolerable difference. Yeah, the tolerable difference. So tolerable difference is 5%, so 0.05 times what? The recorded amount or the expectation? The recorded amount, yes. So times 2,000. So it would need to be within $100. 4575 is $2,575 away. So we're not within $100. This is like the worst Price is Right guess ever right there. With $100 out going over, I'm going to guess 4575. Oh, you're only $2,500 off. All right. So yeah, what's going on here? It looks like they're understating interest expense pretty massively here because we're way off of what the expectation would be. Now, again, if I asked you a question like this on the exam, you wouldn't be able to just say, well, 4,500 is much greater than 2,000. That's a true statement, okay? But your rationale, your reasoning has to be, I actually did the calculation. I know it has to be within $100. It's not. It's not even close to $100. So that's why I would have rejected this. That's just a reiteration of what we did back in chapter 5. Still holds true because remember, what we learned previously, we still have to use moving forward. All right, chapter 16. All right, so this is 1628. And we've got a whole bunch of audit procedures here. So what I want you to do is I want you to ignore the first 3 items. And then you were going to look at every single item after that. And you were going to say, let's see, whoops, sorry, we're down here. My apologies, down here. So ignore the first 3 items and look at 4 through 8 and say, what are the primary financial statement assertion relative to investments that would be addressed by each procedure? All right, so let's do that. All right. So again, keep in mind that for some of these procedures, we can test multiple assertions, but we're concerned about the primary financial statement assertion. So what is the main assertion that's being addressed through each procedure? So first one is going to be obtain positive confirmation of the investments held by an independent custodian as of the balance sheet date. This is definitely one that can test multiple assertions, but our primary reason for doing this particular test is to test which assertion related to investments. So investments are assets. We confirm assets. We're generally trying to confirm which assertion. Existence occurrence. Yeah, existence occurrence. Okay. Determine that income and investments have been properly recorded as accrued or collected by reference to published sources, by computation, and by tracing to recorded amounts. All right, so this is a really, really critical one. This one's not immediately obvious, okay? It looks like that we're looking at items and we're saying, all right, we're trying to determine what whether the mathematical accuracy is correct. And the word computation is a little bit throwing off because that kind of implies mathematical accuracy. But is that what the overall question is asking? Is it asking, was it recorded for the correct amount? It's asking, was it recorded, period? What is our recording assertion in this course? Completeness. Yeah, if you don't know that by now, I'm really, really sad, okay? I failed you. I've let you all down. So we're talking about completeness here. Did something get recorded? For investments in non-public entities, compare carrying value information to the most recently available audited financial statements. Okay, so this one actually talks about a value and determining that the values are consistent across. So we want to make sure that whatever's been in the financial statements is what's in the financial statements actually matches items that's in the carrying value or carrying value information. So what do you guys think for 6? Carrying value is kind of a key there, okay? We're talking about valuation, so it's VAA. VAA is our assertion here. Determine all transfers among held to maturity trading and available sales securities have been properly authorized and recorded. Okay, so this one's kind of a tricky one. Now, usually, I'd say 9 times out of 10, and this is the case here, when we talk about the transactions related to investments, when they start mentioning the category of investments, whether it's going to be held to maturity, trading, or available for sale securities, we're trying to make sure that these are actually put within the correct category. For trying to identify the investment category, what is this going to be an assertion related to? Classification, okay? Now, there's an argument that you could actually say that there's also some presentation issues here. And if you put presentation here as an answer, I would accept that was be a plausible answer as well. Also, if you put authorization here, I would say authorization is not a real assertion, but that's correct. We are trying to determine authorization here. Authorization is a separate entity into itself, not as a fund management assertion. All right, determine that any other temporary decline in the price of investment has been properly recorded. Okay, so this one's interesting. There's actually arguments for two different assertions here because it specifies that something has been recorded, which if we're talking about something just being recorded, period, we're talking about what? Completeness, okay? Now, the question is does properly recorded mean that it's been recorded at all, or was it recorded to the correct amount? And there's some difference from interpretation here. I personally believe that if it's saying it's been properly recorded, that means that it was recorded. We're just trying to make sure that the amount is correct. If that's the case, then we're talking about which assertion? VAA. Good. VAA. All right. Last EWC assignment of the semester. Let's get on it. All right, so we're doing some cash testing, which is going to involve bank reconciliation procedures. Now, one thing that we have to note here is that you had to identify here, and I probably should include this tab here, but to be honest, I'm not as concerned about this because I think this is fairly intuitive. But I thought that this tab was actually very beneficial for identifying where each of these procedures would fall among the work papers. So I do hope you completed this, even though this wasn't part of your deliverable. And this would be something that you would have to track in the real world. You have to say, all right, here are the audit procedures. Where did I perform these procedures? They have to identify those. And you put your own initials there and you would say if there's concern. And by the way, you should have identified a concern because there was an issue in this particular process. So let's go ahead and go through each of these steps and identify where the concern came up. All right. So we've got some tick marks we have to add, and this is basically filling in tick marks. That's all this procedure was, which it looked like a massive spreadsheet. Did anybody see the spreadsheet and just really panic and say, this is going to take me hours? It actually is not that long. It's just there's a whole lot of information that you have to cross-apply information to. There are some EWC assignments that actually do take a while, but I cut those out simply because I didn't think they had the same impact as the other ones. This one I think is a good one, even though it's a little bit intimidating. So yeah, let's go ahead and let's talk about, again, general concepts with respect to bank reconciliation. What are we trying to determine? We're trying to determine, is this number correct? Okay, that book balance, is that book balance correct? And if that's the case, then we have a lot of, we can actually validate the amount that's recorded in the financial statements. That's what we're trying to determine. How do we do that? We look at what the bank says, and we look at all the changes that explain the difference between what the book says and what the bank says. So this is what the bank is telling us, this is what the book is telling us. So there's our reconciliation. We got our first document. We need to verify the information that's at the bank for the bank balance. What does that come from? What was that document called? The standard bank confirmation. Remember it. Love it. Be able to regurgitate it because it will come up. Okay. Standard bank confirmation. Standard bank confirmation. So let's just go ahead and add a tick mark to verify that this is where we got this information from. That's actually the letter C. If you look down, it says trace to the standard bank confirmation, which if you ignore the word traced, because it's not used correctly here, okay? But if you ignore that, we are looking at the standard bank confirmation, okay? Which is going to be the 16.3, which we'll look at here in just a second. All right, let's go ahead and while we're still here on this item, what are we also trying to determine? We're trying to determine these transactions that are listed here, that these are accounted for. Now, technically speaking, we probably should have all these checks here listed as well. And you can notice that there's adjustments available for them, but for the most part, those are not adjusted. Although interestingly, you still have drop-down menus that you could go and fix if you really wanted to. You can go and change them. So if you really wanted to be a bad auditor, you could go ahead and adjust those as well. Although, is this in your homework? This is in your homework assignment, or is this? No, this should be, these were already populated, correct? Okay. I was starting to think it's like maybe I'm correct. Maybe I already put this in a drop-down menu in a previous year and I forgot about it. But no, we're good. So what does this item mean? Okay, it's a circle with a slash that said examine, cancel, check, or wire transfer authorization for proper paying amount and endorsement. Okay, so we can actually look at the cutoff bank statement. We can also look at the checks themselves to determine that this information is valid. So that's an approach we can take. For deposits and transits, though, we really only have one item. What is that third document that we obtain as the auditors that we generally try to use to verify these changes? So we have our bank reconciliation, we have our standard bank confirmation. Our third document is the one that looks in the future. Have we just really forgotten this? I said, you got to know these three documents, and now I've got like silence, okay? Says, Dr. Barnes, it's the cutoff bank statement. We all knew that. We just wanted you to say it for us. Okay. Well, I said it for you. Okay. I'm not going to say it for you on the exam. If you say, Dr. Barnes, what is the third document? I'm going to say, well, that's up to you to know. All right. It's up to you to know. All right. Hudson knows it, but yeah, I want making sure everybody else knows. Okay. So I've called you out twice today, Hudson. I'm sorry about that. Yeah, now I've called you out 3 times. Yeah. Okay. All right. So what are we looking at for cutoff bank statement? So if we go to the cutoff bank statements, we're going to this diamond. Okay. So putting the diamond in here. You all should have even been able to identify that. Assuming you got the tick marks correct. It says cutoff bank statement right down here, guys. Okay. Put the diamonds in. I'm going to continue ranting. You guys are going to have to deal with it. All right. All right. Moving on here. We got our standard bank confirmation. All right. So standard bank confirmation, this $3,705,473. If we go back, that's the balance that we have right here. So we can say that this actually gets matched to 16-2. Is everybody good with that? By the way, what's this called? We got a reference here. We also got a reference here, and those references appear to refer to one another. What do we call that? It's an important characteristic of audit documentation. So we had the heading because the heading's up here. Okay. We got tick marks, but what fell in the middle? Indexing and what? Cross-referencing. This is a cross-reference. Isn't that great? Isn't that great when things come together? We got multiple cross-references in these work papers, but that's a cross-reference. Validates information to shows where the information came from and where it's going to. All right. Isn't this fun, guys? Do you want to just go right out into the real world and just start doing validations of cash? Yeah. All right. So we've got an item here. It's a cutoff bank statement. So our cutoff bank statement is telling us information that's in our reconciliation, trying to validate that. So it's interesting here because you notice that we put in 3 tick marks, but we've got 4 items that are not accounted for. Okay. So the NSF check charge, can we say that that was on the reconciliation? Yeah, it was on the reconciliation. Oops, did I put the wrong tick mark? I think I did. Yeah, it's a triangle. Sorry, my apologies. Trying to give you guys the wrong tick mark information. Triangle. And we're going to put the triangle here. Okay, so. All right. So what's going on with the December bank charges? Why did I not put a triangle there? It's not on the reconciliation. So what would you do as an auditor here? Just say, well, it's only $275, not a material amount. Or would you say, I need to know what the heck's going on here. It's probably nothing, but I still want to follow up on it. So let's go ahead and put error. Tells us something we need to investigate. Something why was not included in the bank statement, the bank reconciliation, and we need to figure out what's going on. Where did that come from? All right. Next steps are going to be some additional procedures. You'll notice here we got proof of cash. Now, proof of cash, what did I say? Basically, proof of cash is a little bit like a fixed asset roll forward. We're trying to determine what is the ending balance correct based on what the beginning balance is and the changes during the period. Okay. This is one of those steps that we would take if we think fraud has occurred. Now, I want to note here, if you see a $275 bank error, this is probably not an indication of fraud in an organization. Okay. This is mostly just added as an additional procedure to kind of validate that. So I want to say that even though this would only be used usually in case of fraud, we're not suspecting fraud. This is just mostly an additional procedure that's been thrown in for this activity. So let's go ahead and determine what's going on here. So a lot of transactions here, and you'll notice up here that we've got some information that's pretty consistent. So we can actually trace this information back. I use trace wrong again. My gosh, it's overwhelming. It's killing me too. Okay, I would agree this information back here. This is the deposits that we've seen before. But we can actually look at this aggregate information such as receipts and disbursements, and we can tie this information across. So if you look at 16.6, this is our cash receipts journal. Look at 16.7, this is our cash disbursements journal. Should the amounts aggregated here, the balance per books, match those disbursement amounts or the receipts into disbursed to journal amounts? They should. And we've actually got tick marks for that. Okay. So let's go ahead and put those tick marks in if I can find my correct working paper. So this is the one that right here. It's the one here. And then also we're going to add this tick mark over here because we want to make sure we know that these were items that were on the cutoff bank statement that we matched up. All right. So then we only have one more tick mark on each of these last two, but we have to make sure that these are correct. So if we look, our receipt, a net receipt should be 157,491 roughly, okay? So that's the number here. So we're going to go ahead and put a triangle here. And again, we have this amount here with a tick mark here, and this amount here with a tick mark here. They're referring back to one another, which again, we call a cross-reference, okay? We're cross-referencing information so we know where the information or originates and where it ties back to. Same thing for 16.7, that we're going to put another triangle over here. The delta symbol, I guess I could use the correct vernacular, okay? And we got another cross-reference. So all of our information is neatly tied to one another. We know where it comes from and where it goes to. Now, the most important takeaway is this an evaluation, okay? Is this evaluation. So let's talk really quickly about some of these items. Now, it does give you some very specific words. It uses the words incorrectly, particularly if you think about the context of what the information is. So let's just go ahead and talk about what are the assertions that we'd be very concerned about in each of these scenarios. So agree the bank balance to the bank reconciliation with the balance shown in the standard bank confirmation. So if you're agreeing information in the bank reconciliation to the number or the bank balance, the top line item to the bank reconciliation, what is your primary concern as an auditor? So probably existence occurrence is going to be one of those concerns. Is there another additional concern we want to make sure that if those numbers are trying to agree? Yeah, VAA. So probably existence occurrence and VAA would be our primary assertions in this area. So we could say those two. What about tracing, ignoring the word trace, okay? Saying the deposit in transit to the bank reconciliation to the cutoff bank statement, okay? So if we're talking about deposits, we're probably also still concerned about existence occurrence, okay? Because it's very, very common for our organizations to overstate their cash position, and they would do so by misstating deposits in transit. Could we also be concerned about VAA in this area? Yeah. Is there any other one that we might think? I'll give you a hint. It's called the cutoff bank statement for a reason. Yeah, cutoff. We'll probably want to do cutoff here as well. So probably talking EO, or VAA, and cutoff. What about agreeing any charges on the cutoff bank statement to the bank reconciliation? So that one's going to be primarily cutoff and accuracy VAA, okay, for the same reasons above. We're not as concerned about EO, not even completeness, because the charges are generally not going to be material. Agree the December cash receipts shown on the proof of cash with the December cash receipts journal, okay? By the way, an interesting question. This is not listed up here. But if we listed the procedure for testing the checks, outstanding checks, okay, would we still say that it's going to be existence occurrence, VAA, and cutoff? Probably VAA and cutoff, yes. But would existence occurrence still be our primary assertion for checks? No. Probably what would be the assertion that we'd be concerned about? Completeness. We'd probably be most concerned about completeness. All right. Agree the December cash receipts journal shown in the proof of cash of the December cash receipts journal. This is primarily going to be VAA. This is also going to be VAA on the cash disbursements. And then trace or agree any bank charges or adjustments listed on the proof of cash to the cutoff bank statement. Okay, so we're actually going back to that original document, make sure VAA, can we agree that that's probably going to be an assertion that's going to be relevant? So you'll notice here that for every single one of these, we listed VAA as an assertion. Can we agree that for cash, VAA is probably a really important assertion, especially when we're testing cash? Hopefully you got that as a takeaway. If you didn't, I can't help you. But yeah, that's going to be the goal here. What might be another concern here? Well, when we're testing the cutoff bank statement, cutoff is always going to be relevant because we're being concerned about items that were recorded within a specific period. So yeah, that would be a list there. Yes.
On the bank rec, there's a check that's not on the cutoff bank statement. Would that be something like
So it really depends on what the date of the check is. So first of all, the cutoff bank statement, if we're talking about something that should have been listed on the cutoff bank statement, yes, we'd probably investigate that. If it's something that occurred after the cutoff bank statement, but still during part of the testing, then we wouldn't worry because we'd assume that that's probably something that, or I guess it's the other way around. If it's a cutoff bank statement, it's a check that did not appear. If it had cleared before period end, if it was not cleared before period end, I didn't ever notice that before though. So I would assume that if it's still outstanding, it should be on the cutoff bank statement. So we got a check that's listed here that's not on the cutoff bank statement, huh? 22,750. I'll have to investigate that and get you because that's not ever been listed on the solution. But yeah, let's see. What is the date about when this took place or when the test took place? Because this is supposed to be outstanding at the period end. But so, yeah, I'm gonna look into that because I'd never noticed that before. I just kind of took it as face value. The answer would be absolutely yes. It would be a concern because on the bank reconciliation that would reply something that took place at before or to resolve at period end. It should have been cleared within that period of time. So yeah, good observation. All right. Any other observations that I missed that McGraw-Hill missed? McGraw-Hill misses a lot, sadly. But all right. We are back on Monday for exam review. I'll see you all then. Have a good weekend.